Now let's move on to something called the seasoned QM rule. When the CFPB conducted its mandated 5-year assessment of the ability to repay qualified mortgage rule, amongst its findings were that a robust and sizable market to support non-QM lending had not emerged, with private label securitizations still a fraction of their pre-crisis levels, and that it is possible that this market might not exist even with the narrower GSE QM loan definition as mentioned above, if consumers were unwilling to pay the premium charged to cover the potential litigation risk, meaning a higher rate due to the risk to the lender, for originating a non-QM loan, which does not have a presumption of compliance with the ability to repay requirements, or if creditors were unwilling or lacked the funding to make the loans as a result of the potential litigation risk. These findings, exacerbated by the COVID-19 emergency, led the CFPB to adopt the seasoned QM rule, which its stated goals being to ensure access to responsible, affordable mortgage credit and encourage safe and responsible innovation in the mortgage origination market, including for certain loans that are not QMs or are higher price QMs under the existing QM categories. So what does all this mean? Well, in their attempt to achieve these goals, the seasoned QM rule provides a means by which non-QMs and higher price QMs following their origination can acquire safe harbor protection from liability under the ability to repay qualified mortgage rule based on specified performance and portfolio requirements. The seasoned QM rule defines a seasoned QM as a loan that is secured by a first lien, has a fixed interest rate, and is not a high-cost mortgage, and that satisfies the general QM product requirements, such as no negative amortization, no interest-only or balloon payment features, a term of less than or equal to 30 years, and total points and fees generally less than or greater to 3% of the loan amount. A seasoned QM loan is also a loan for which the creditor, during the underwriting process, considered and verified the consumer's income or assets, debt obligations, and monthly debt-to-income ratio or residual income in accordance with the same standards established in the amended General QM rule for General QMs. Finally, a seasoned QM loan is a loan that is held in portfolio by the original creditor or the first purchaser for at least 36 months, not counting periods of temporary payment accommodation due to a disaster or pandemic-related national emergency. That is what is called the seasoning period, during which time the borrower has no more than 2 30-day delinquencies and no delinquencies of 60 days or more. In adopting the seasoned QM rule, the CFPB reasoned that, in general, the earlier a delinquency occurs, the more likely it is due to a lack of ability to repay at consummation than a change in the circumstances after the consummation that the creditor could not have reasonably anticipated from the consumer's application or the records used to determine repayment ability. And they determined that 36 months was an appropriate seasoning period based in large part on similar periods after which the GSEs and mortgage insurers release creditors of performing loans from the threat of enforcement of their required underwriting-related representations and warranties when the loans are sold to them. So in conclusion, the ability to repay qualified mortgage rule was a reaction to the liberal underwriting policies of some lenders that helped bring down the market back in 2007-2008 in what is dubbed as the subprime mortgage meltdown, which of course caused a wider economic crisis following that meltdown. Did it succeed in protecting many consumers from taking out loans that they could not afford to repay and having to suffer the consequences? Sure. But unfortunately, because of the lender and investor concerns over significant and potential life of loan liability for a violation of the ability to repay a qualified mortgage rule, it has prevented other consumers from obtaining loans that they could afford to repay or caused them to have to pay a liability premium for those loans. At a minimum, the new final rules appear to make much needed adjustments to the ability to repay qualified mortgage rule, which overall should result in increased mortgage credit availability as well as lower costs for some deserving borrowers, while continuing to protect others most in need of the rule's protection. Mortgage lenders and secondary market investors should actually be pleased by this update, and so should the borrowers who have been locked out of the market under the current rule.